Okay, so let's dive into this. IT spending. It's often felt a bit, fuzzy, right?
Yeah, fuzzy is a good word. Sometimes it's just seen as, well, a cost you have to pay, like keeping the lights on.
Or, on the other hand, it's all about chasing the latest tech trend, the shiniest new toy.
Exactly. But the source material we're looking at today, from Dr. Paolo Fontana, a finance pro, argues we need to completely reframe that.
Reframe how?
He says we need to see IT capital expenditure CapEx as a proper strategic investment, one that absolutely has to prove its economic worth.
Okay, so treating IT not as overhead, but as capital that needs to generate a return. Makes sense.
Right. And that's our mission for this deep dive, exploring Dr. Fontana's view. He's calling for a really systematic, finance-first approach.
Finance first for IT. Okay.
And he starts with a pretty startling claim. He argues a lot of IT spending just doesn't deliver real economic value.
Really? How much are we talking?
Well, it leads to millions, sometimes, tens of millions of dollars being written off, and shockingly quickly, too.
Written off. Just gone. That really grabs your attention, doesn't it?
Sure does. It suggests something's fundamentally broken in how these spending decisions get made.
So what's causing this? What's the root issue, according to Fontana?
He calls it the elephant in the server room. He points out that these capitalized IT projects, things meant to be long-term assets, often get written off in just, say, 3 to 4 years.
Wow, 3, 4 years. That's way faster than you'd expect for a major investment.
Precisely. It means they stop delivering the expected value much, much sooner than anyone planned.
Okay, so that's the symptom. What's the disease?
He basically pins it on neglecting, or maybe just poorly executing, fundamental financial principles.
Like what?
Well, things like rigorous cost-benefit analysis, really understanding payback periods, calculating net present value NPV or internal rate of return IRR, fundamentally just losing sight of the main goal,
Which is?
creating actual economic value for the business, for its stakeholders, not just, chasing exciting tech or building up big IT departments.
Right, so he's not dismissing the tech itself. AI, cloud, all that stuff is powerful.
Oh, absolutely not. He gets the passion, the interest, but he's trying to bring it back to financial earth.
Technology as a means to an end, not the end itself.
Exactly. The end goal has to be generating economic value. He warns against getting, as he puts it, drunk on innovation, only to end up with that multi-million-dollar write-off hangover.
Okay, I see the picture. The hangover is definitely something businesses want to avoid. So if IT CapEx is an investment, how does Fontana suggest we apply this financial rigor? Where do we start?
Well, the first big step, he argues, is realizing you can't just treat all IT spending the same. It's not one big bucket.
Right. Different types of projects probably have different goals.
Exactly. Different categories need different ways of thinking about their returns, different metrics. You can't apply the same yardstick to everything.
Okay, so he breaks it down.
Yes, into 5 strategic categories. It's quite a useful framework.
Let's walk through them. What's the first one?
Category 1 is the absolute bedrock. Infrastructure and core systems. Think data centers, servers, your main ERP system, basic cybersecurity. The essentials.
The plumbing, basically.
Pretty much.
Yeah.
And the value here isn't usually direct revenue. It's about stability. Can you scale up? Are you mitigating fundamental risks? It's the foundation.
Got it. Value measured in reliability capacity, not dollars coming in the door directly. What's next?
Second is productivity and efficiency enhancements. These are projects aimed squarely at making the business run smoother, faster, cheaper.
Okay, like automating tasks, reducing manual work.
Exactly. Maybe a new workflow system. Or optimizing part of your ERP.
Uh-huh.
The value here is very tangible. Cost savings, measurable gains in efficiency. You can often point to headcount reduction or faster processing times.
Makes sense. Greasing the wheels internally? What about projects aimed at the top line?
That's category 3, revenue generation and customer-facing initiatives. These have a direct link to bringing in cash. Things like building a new e-commerce site, implementing a CRM system to boost sales effectiveness, customer portals, maybe adding new digital features to a product.
So success is measured directly in revenue growth, or maybe customer retention.
Precisely. Measurable impact on the top line
Yeah.
or customer lifetime value. Very clear connection to the cash register.
Okay, then there must be projects you just have to do, right? Like regulatory stuff.
Spot on. Category 4. Compliance and regulatory mandates. Think GDPR updates, critical security patches required by law, industry-specific rules you have to follow.
The must-dos.
Absolutely non-negotiable. And the value here isn't about making profit, it's about avoiding loss. Huge difference.
Avoiding loss. How so?
You're dodging potentially crippling fines, legal trouble, or, importantly, massive reputational damage if you fail to comply.
So the value is preventing disaster, basically. Okay, that's four. What's the fifth? This sounds like the tricky one.
It often is, especially for finance folks. Category 5, innovation and strategic exploration. These are your moonshots.
The experimental stuff, AI pilots, R&D.
Exactly. Higher risk, often longer-term bets on emerging tech. They have high potential upside, but they're inherently uncertain. Much harder to pin down with traditional financial models up front.
Right, the value isn't always clear on day one. He also mentioned something about urgency tiers.
Yeah, you can kind of overlay that. There are the must-haves projects where not doing them means serious penalties or you literally can't operate.
Like that compliance stuff, or maybe a critical system replacement.
Right. Then should-haves projects with clear, quantifiable positive impact on the bottom line, like cost savings or new revenue.
Those efficiency or revenue gen projects.
Exactly. And finally, the nice-to-haves. These are more incremental improvements. They naturally face the toughest scrutiny, the highest hurdle for getting approved.
Okay, this categorization makes a lot of sense. So once you've put a project in a category, the next big hurdle is actually measuring its potential value, right?
Right.
Moving beyond just saying it's good for the business.
Absolutely crucial. This is where Dr. Fontana really insists on discipline. No more fuzzy math.
So what does he require for every IT CapEx proposal?
3 key things, no matter the category.
Uh-huh.
First, a clear business case. What problem are you solving or what opportunity are you chasing, and what are the alternatives? You can't just look at one solution.
Makes sense. Second.
A really detailed cost analysis. And this needs to be truly comprehensive, not just the vendor invoice.
You mean like internal staff time, training, ongoing costs?
All of it. Internal resources, cloud bills after launch, support contracts, depreciation,
Yeah.
all those things that often get underestimated or forgotten.
The hidden iceberg below the initial price tag. Okay, third.
And this is often the weakest link, he says. Rigorous benefit quantification. You have to put realistic numbers on the expected positive outcomes.
Okay, quantifying benefits. How do you do that, especially for things that aren't direct revenue?
He breaks it down. First, the easy ones. Tangible benefits. These are things like cost savings, maybe needing fewer people for task, reducing errors that cost money, lower maintenance on old systems.
Straightforward enough.
Or revenue enhancement, more sales, better website conversion rates, getting products to market faster, better customer retention, maybe even entirely new revenue streams.
Also fairly direct. But what about those avoided costs you mentioned? For compliance or replacing risky old gear? How on earth do you quantify something not happening?
This is where his framework gets really practical. You calculate what he calls the expected avoided cost. It's a probabilistic approach.
Probabilistic. How does that work for, say, a compliance project?
Okay, take that GDPR example he uses. You estimate the potential fallout if you don't comply and have a breach. What's the potential fine? Add the cost to fix everything. Add an estimate for the hit to your reputation, maybe lost sales, brand damage. Let's say that all adds up to a potential $15 million downside.
Okay, a big potential hit.
Now, the key step. You assess the probability of that happening within a certain time frame, say per year, if you don't do the compliance project. Maybe based on your current systems, the risk is assessed at 20%.
So it's 15 million potential loss times a 20% chance.
Exactly. 15 euro 0.20 gives you 3 million. That 3 million is the expected avoided cost per year. It's the financial value of doing that compliance project. It generates 3 million in value by reducing that specific risk.
Wow. Okay, that suddenly makes compliance spending look like a very rational financial decision, not just a sunk cost. It has a measurable positive value.
It absolutely does. Same logic applies to avoided disruption costs when you're replacing old unstable systems.
How so?
You figure out the cost of downtime. If that old server fails, how much revenue or productivity do you lose per hour, per day? Then you multiply that by the probability of disruption, maybe based on how often it's failed recently or its age.
So if a failure costs, say, 50,000 euros a day, and the system has maybe a 10% chance of a major failure this year,
Then the expected cost of not replacing it is 5,000 euro point euro, 50,000 euro point 1 euro. Investing in the replacement project delivers 5,000 in quantifiable benefit by preventing that expected disruption. It stops a potential financial bleed.
that's a very clear way to frame it. What about projects that enable growth, like buying laptops for new hires?
That's a bit different. It's not avoiding a cost, it's enabled growth. The benefit of buying those laptops isn't the laptop itself. It's the revenue or productivity those new salespeople or developers will generate because they have the tools they need. The IT spend unlocks that new economic activity.
Got it. So once you've rigorously estimated the costs and these quantified benefits,
Yeah.
then you bring in the standard financial toolkit.
Precisely. Now you apply the corporate finance scorecard. You look at the payback period, how fast you get your initial investment back. Simple, quick check.
But maybe too simple. Doesn't account for value after payback.
Right. It's useful for cash flow concerns, but not the whole picture, which is why you absolutely need net present value, NPV.
The gold standard, right.
Pretty much. Does the project, considering the time value of money, actually add absolute dollar or euro or whatever value to the company? Dr. Fontana is blunt. If the NPV is negative, it destroys wealth. Don't do it.
A clear red light. What else?
Internal rate of return, IRR. What's the project's effective percentage return? Does it beat your company's required rate of return, the hurdle rate?
Another key hurdle.
Yes. And then there's economic value added, EVA. This one's powerful because it looks at profit after accounting for the cost of all the capital tied up in the project. EVA equals net operating profit after tax minus the charge for the capital employed, which is capital employed times the weighted average cost of capital, or WACC.
So does it generate profit above and beyond what that capital could earn elsewhere?
Exactly. It aligns very closely with creating shareholder value.
Mm-hmm.
And finally, return on invested capital, ROIC. How efficiently does this specific project use capital, and how does that impact the company's overall ROIC?
Okay, that's a solid set of metrics for projects where you can reasonably quantify benefits, like cost savings or avoided costs. But what about category 5? Innovation, strategic exploration. You said traditional NPV struggles there.
Right, because the value isn't just in predictable cash flows 5 years out. Often, the main value of an initial innovation project like a pilot is the learning and the options it creates for the future.
Options, like choices.
Exactly. This is where Dr. Fontana brings in a concept from finance called real options. It's about valuing flexibility.
Real options.
Oh.
Sounds interesting. How does it work?
Think about a financial stock option. It gives you the right, but not the obligation, to buy or sell stock later. A tech pilot project can do something similar for the business. It creates managerial options.
What kind of managerial options?
Well, the option to expand the project if the pilot works well, the option to abandon it quickly if it fails, cutting your losses, maybe the option to defer a bigger investment until the market is clearer, or even the option to switch to a different approach based on what you learned.
And traditional NTV just misses the value of having those choices.
Often, yes. It tends to focus only on the most likely cash flow scenario and undervalues that strategic flexibility.
Can you walk us through that AI pilot example he uses? That sounds like a concrete way to see this.
Sure. Imagine an AI pilot. Initial cost, the CapEx, is 750,000 euros. Now, if you just run a standard NPV based on the immediate predictable impacts, it might actually come out negative. Let's say it's negative 200,000.
So based on traditional finance, you'd kill the project right there.
You probably would.
Yeah.
And potentially kill a huge future opportunity. But real options thinking says, wait a minute, what if this pilot has a 40% chance of being successful?
Okay.
And if it's successful, it unlocks a much bigger phase 2 project, maybe a full rollout, that has a potential future NPV of plus 5 million euros.
Right. And if it fails?
If it fails, a 60% chance you just stop. You abandon the idea. Your loss is capped at the initial 750,000 pilot cost.
So for 750K, you're buying a 40% shot at a 5 million prize and a 60% chance of losing just the 750K.
That's the essence of it. A simplified way to value the option created by the pilot is to look at the expected value of the upside, probability of success NPV of that successful outcome, minus the cost to acquire the option, the pilot cost.
So 40% times 5 million minus 750,000.
Exactly. 0.4 euro, 5,000 euro, 5,000 euro. That's 2 million minus 750,000, which equals 1,250,000.
Hold on. So the option itself, the flexibility and potential unlocked by the pilot, is worth 1.25 million.
According to the simplified real options view, yes. Even though the pilot's immediate NPV was negative.
So the total strategic value isn't just the negative NPV.
No. The total value is the pilot's standalone NPV plus the value of the option it creates. So it's negative 200,000 plus 1,250,000 euro plus 1,250,000 euros.
Wow. That completely flips the decision. The project looked like a value destroyer, but valuing the option shows it actually creates significant potential value.
That's the insight. Real options helps justify those strategically important but uncertain innovation bets. It quantifies the value of buying future flexibility and knowledge, which traditional methods often miss. It's about investing smartly in potential.
Okay, this framework is incredibly thorough on the front end, planning, evaluating, using sophisticated tools like real options. But what happens after the money's spent and the project is live? Is that it?
Absolutely not. And Dr. Fontana stresses this is a huge failure point in many companies. There's one last step that is absolutely non-negotiable.
Which is?
The postmortem, the look back.
Avoiding the launch and forget mentality.
Precisely. You have to follow through. You need to track the actual costs. Did you stay on budget? Where did you deviate?
And crucially, the benefits. Right.
Even more crucially, did those quantified benefits actually show up? Are the efficiency gains real? Is the revenue lift happening? Did downtime actually decrease? You have to measure against the original business case promises.
Compare the forecast to reality.
Yes. And the most important part isn't just seeing if you were right or wrong. It's the feedback loop. Why were the cost estimates off? Why did the benefits materialize differently than expected?
So you'll learn for next time.
Exactly. This learning is what helps you refine your estimation models, improve your business cases, and ultimately avoid repeating the mistakes that led to those massive write-offs we started talking about. It closes the loop, makes the whole process smarter over time.
It really connects back to the beginning, doesn't it? Preventing those initial horror stories. So this isn't just a set of rules. It sounds like it requires real partnership between finance and IT.
Absolutely. Dr. Fontana is very clear about the roles here. It's a call to action for both sides.
What does he see as finance's role?
Finance needs to be the firm but fair gatekeeper. They need to demand that rigor, push back on vague justifications, insist on quantifiable answers, and importantly, they need to help educate IT on these financial concepts and why they matter.
So setting the standards and ensuring they're met, what about IT's role?
IT needs to fully embrace this financial perspective. Their technical brilliance is essential, of course, but it needs to be connected to economic reality. They need to see technology as an investment that must deliver a return.
Not just cool tech for tech's sake.
Right. They need to learn and use the language of NPV, IRR, ROIC, EVA. Not just to get funding, but to become true strategic partners with finance and the rest of the business in driving value.
So the ultimate goal is, well, it's pretty clear, isn't it?
Yeah. Stop the write-offs. Stop treating IT like some kind of black hole for money. Start making IT investment a predictable, measurable engine for creating real economic value for the company.
It's a powerful vision.
It really is. Apply this finance-first thinking. Categorize spending properly, demand solid numbers for costs and benefits, use the right metrics including real options when needed for innovation, and always do the postmortem. That's how you turn IT CapEx from a gamble into a strategic advantage.
This deep dive into Dr. Fontana's ideas, it really makes you think about how many IT decisions get made without this level of scrutiny.
It definitely does. It leaves you wondering, doesn't it?
Wondering what?
Well, for anyone listening,
Yeah.
just how transparent, how value-focused is the IT spending process in organizations you deal with, even in your own work? And maybe more importantly, how could applying some of these ideas change that whole conversation?
Right.
Shift it away from just cost and complexity towards actual investment and measurable results.